last 6 months, we haven't made big changes to the positioning of the trust. I think it stays pretty consistent. We're looking for a balance between growth and income from the portfolio, and we do that with a list of quality equities, about 30% in preference shares to deliver high income and capital stability, and generally we try and think about things as a stock specific basis and not on sector allocation. So we haven't changed positioning too much. The one thing that's maybe changed in the last 6 months is we've taken some weight out of real estate within the UK. We did that at the end of the last year, just taking the view that as you see both economic uncertainty, which perhaps has a negative impact on rental yields for property, and also higher interest rates, which mean cost of debt goes up for these companies, the income potential from those businesses is lower than it was in the past. So we took a fairly material reduction to real estate exposure at the end of last year. But otherwise, keeping a really balanced portfolio, we're overweight some of those sectors where you have better income, like energy and financials, but also plenty of exposure to more growthy things like healthcare, for example. So over the last 6 months, the trust's NAV has grown by about 14%, and that puts it roughly almost exactly in line with the FTSE 350 benchmark for us. For the trust, I think that's a good performance. We don't always expect to keep up with or beat the benchmark in a period of rising markets because we do have quite a defensive position and we're looking to generate income as well. So that kind of growth in 6 months is a good return, I think, for shareholders. And importantly, the income outlook has remained very robust. Income is still growing from the portfolio, and we're seeing a well-covered 5.5% dividend yield on the shares, which is very attractive as we think about what is going to contribute to investor returns going forwards. In a period where we see some risks to market levels, actually generating that stable income is really important for us at the moment. So I've already touched on the reduction in real estate weight, which was the big sector change for us. Other than that, we've tried to be fairly nimble in what we're doing in a period where markets have been particularly volatile. And it feels like they've been volatile for the last 3 years, but that's certainly continued in the last 6 months. So examples of that would be selling down our exposure to iron ore producers like Rio and BHP near the start of this year because we felt there was a lot of optimism about Chinese recovery and the share prices has gone up. And we rotated that into some more diversified miners, Anglo-American, for example, where we see just a better long-term balance for their commodity exposure. Similarly, when we saw bank shares very weak in March this year, as you saw the failure of Silicon Valley Bank in the US and then the failure of Credit Suisse in Europe, that was an opportunity to top up some of the bank shares we like because the risk of contagion is relatively low, valuation is attractive, and income potential from those stocks is still very good. So we're just trying to find those opportunities that give us an opportunity to buy at attractive yields, buy good quality companies we like, and take advantage of a bit of market volatility and uncertainty. I think other trades we've made have been more consistent with what we do usually. And we're usually looking for one of two things. One of those would be resilient income. And examples of things we've bought there would be Engie, which is a French utility with a very well covered 8% dividend yield. Or something like Smith & Nephew, which is resilient, starting to grow its dividend again, and will be defensive. And then on the other side, we're looking at quality growth names, which can provide that balance in the portfolio and give us capital growth over the long term. And examples of things we've bought there would be Doceo, which is a animal pharmaceuticals business, or Genus, which is another animal exposed business doing animal genetics. Both not necessarily high yields, but very strong growth, very high quality companies, which we want in the portfolio just to deliver that balance over time. So two recent purchases I'll talk about are really things that bookend the two ends of the spectrum for us. Two very different companies, but both of which we think will contribute to investor returns over time. The first of those is HSBC. So it's a mega cap global bank. It's highly liquid, and it's definitely in the value end of the spectrum. So trading on less than 6 times earnings multiple when we bought it, with a 9% dividend yield, It is certainly optically quite cheap. And we bought it, as I mentioned, at a time when bank shares dipped post the Silicon Valley issue. And from our point of view, there are issues in the banking system caused by rising interest rates, but they tend to be quite localized. And what we expect to see is a flight to quality of deposits, which will help large players like HSBC. And at the same time, you have exposure to strong growth from Asian markets, where they have a very strong franchise. And in fact, what we would expect is that as Credit Suisse and UBS come together, HSBC can be a natural winner of market share in the really attractive Asian wealth management market as well. So buying that kind of company with good growth, dividends that are growing again and well covered, with a high yield, a multiple at 6 times, which is lower than this stock has traded at for the last 10 years, that's quite an attractive opportunity. So one we wanted to take advantage of. The second stock is really the complete opposite end of the spectrum, which is Genus. And that's a company which supplies animal genetics to farmers, basically, mainly helping them increase yields on pork or beef production. And it's a global business, big seller into China and particularly in the US. It is a much smaller company. It's, at least on multiple terms, much more expensive. It trades about 30 times earnings compared to HSBC on 6 times. And the yield is much lower, at just over 1% yield. But what we like about it is that it is a really high quality business with very high barriers to entry, really strong IP over its genetics, a track record of growth, strong management, a good balance sheet, all those kind of attributes we're looking for in the quality growth names you want to have in the portfolio. And timing wise, it's also one where we can see some catalysts coming up. We see the Chinese market improving for them at the moment, and we also see an important development in terms of genetic development for disease resistance within pigs that they're working on, which could be a really meaningful catalyst as we go through the next 12 to 18 months. So a chance to buy something we think is undervalued in the long term, even if right now the yield is not necessarily that attractive. And what we are seeing, I think, in the UK at the moment is actually those very high quality companies which look expensive but have some scarcity value are increasingly of interest to overseas buyers because they look cheap, as the whole UK market does compared to international markets. And one example I mentioned earlier as a recent purchase was Decra, which received a bid last night at a 50% premium. It just shows you that because the UK market is very cheap at the moment, there's these opportunities for other buyers to close that valuation gap. And something like Genus is a really scarce asset which has that attraction. So we want to own those for hopefully the long term. So outlook at the moment, I think, market levels have continued to go up into a degree of economic uncertainty. I think it's surprising how quickly markets have bounced back post the concerns around the banking sector in March. So market levels to me look reasonably high. I don't expect necessarily markets to rise quickly. And I think that makes it all the more important to drive income growth to deliver a real return for shareholders, and also to be a bit more nimble and try and be very clever about our stock selection to deliver superior returns. In terms of what's important for the trust, it really is those things. Focus on delivering income that is going to be resilient in a downturn and that is going to grow over the long term, and owning quality companies that can outperform the market, that will be defensive, and that hopefully are attractively valued for us. And I think that's the way we can deliver a good proposition.